Welcome to the chat. In today's class, we are going to be making an attempt to understand fair value gap, what fair value gap means in the forex market, and how traders can leverage on the fair value gap in the forex market. Firstly, I will implore us all to develop virtues that are important so as to have the full grasp of all concepts that shall be taught here. The first virtue will be patience. We must be patient with the chart. We must be patient with ourselves in learning as well. And the second virtue is discipline. We must be disciplined in practice, and we must be disciplined in ensuring that we follow all our rules to the book. Fair value gaps are price gaps that occur when there is a significant difference between the closing price of one trading and the opening price of the next, with minimal or no trading in between. We shall have an example of what this means on the price chart, how it displays itself, and why it happens. So when we know why it happens, then we can know how to leverage on it. For instance, we can see this bearish candle. Let us go back to the basics. Let us take less than a minute to explain candlesticks for the sake of beginners that are joining us in this class. However, this is a master class or an advanced class to put it, as this trading style is more suitable for experienced and advanced traders than beginner traders. As you can see, price making a series of lower lows, higher lows and lower lows with a cluster of white candles. These white candles signify selling pressure. Meanwhile, as you can see, price contracting with a cluster of green candles. These green candles signify buying pressure. Meanwhile, a candle that is neither green nor white like this candle signifies indecision in the market. So back to our main discussion. As you can see, this opening price to this closing price, and as you can see in between there is no trading. This is a fair value gap. This is an area of imbalance. As you can see in this candle as well, from here to here, you can see price just moves impulsively down. This is a fair value gap. This is an area of imbalance. So now, what should come to our mind next? What comes to our mind next is what causes this imbalance in price. The reason being is the market is controlled with money, and large institutions, the dominant market participants such as the central banks, hedge funds, brokerage firms, amongst others, they push large sums of money into the market time to time, and when they do this, the market moves impulsively. It moves impulsively. And when the market moves impulsively, it does not wait or it does not retrace back. It keeps tanking, it keeps rallying, and when it does this, it creates an imbalance in price. However, the market is designed to always create an equilibrium of buyers and sellers at all times. So now, as you can see this selling activity with a lot of pressure, the market is designed to create a balance of buyers. So either some months or in some years, price must retrace back to this zone. It is a concrete rule. Price must retrace back to this zone, as we have lots of orders in this zone awaiting to be filled by the market. Let me mark this zone and let me go to the daily chart so you see how this zone is on the days, so you know that on the days as well it probably could reflect. As you can see on the daily chart, this is the zone we have marked here, and on this particular day you can also see a fair value gap. So in this zone right here, there are lots of money sitting down here, there are lots of orders, because just as price moves impulsively down due to the amount of pressure from the sellers, as they have pumped a lot of money into this candle on this particular day, which is the 10th of April. So they pumped a lot of money into the market and price moves impulsively down. So there are still lots of order waiting to be filled here. So the market has to create an equilibrium of buyers back to this zone. When will it happen? I don't know. Which pattern will it give before it comes here? I don't know. But will it happen? Definitely yes. So that is what a fair value gap means in the market. So now, institutional traders and retail traders, they know that once this is created in the market always attempts to create an equilibrium. So in creating that equilibrium, a healthy fair value gap, price will retrace back, few orders then drop. Price will retrace back, fill orders then drop. That is if it is a zone that will hold. So now, another question that should come to our mind is, how do we recognize a tradable fair value gap? Mind you, in the market, you don't just go about and start trading every fair value gap you see. Maybe because you see any fair value gap, then you start jumping into the market. No. We have tradable fair value gaps and we have fair value gaps that should be ignored. You need to know that in the forex market, 90% of what you do is ignoring things that are none of your concern or none of your business. So as I said earlier, this is an advanced trading strategy because trading the fair value gap, it is a trend following strategy. First, we must look for a clear trend. What is a clear trend? A clear trend is a trend that is not a choppy market. It is a trend where we can successfully identify the highs and lows. It is a trend that has a clear market structure. For instance, we can see here we have a clear market structure. We have a low here, we have a lower low, we have a higher low, we have a lower low. So this is a clear structure. And right here we have a lower low, here we have a higher low, and here we have another lower low. So this is a clear structure. So now, how do we identify the fair value gap? We identify a tradable fair value gap. Firstly, we identify the structure, and once we identify the structure, then we look for a break of structure. So a fair value gap that is tradable has to be beside a break of structure. That is the first rule. Here we have a structure here. Let me mark it. Let us mark it. We have a structure here. And we can see that right beside the structure, as this structure is broken, we have a fair value gap here. Right here, we have another structure here. So we are going to learn how to identify a fair value gap and also how to trade them. Here we also have a structure that is broken and price creates another fair value gap here. So once we identify the structure, then we make sure that another candle forms as well, preferably 3 candles, 1 2 3. Then this fair value gap is LD. This is another fair value gap, 1 2 3. Then this is also LD. So this fair value gap here and this fair value gap here, they are both LD and tradable fair value gaps. Mind you, once a fair value gap forms, if price has traded back into it, it becomes weak. Although that still doesn't mean you can't trade them. So we are going to learn how to find a strong zone in a weak fair value gap, because as you can see, this weak right here, it has traded back into this fair value gap. So as long as price has traded once, it is no longer a virgin zone. So for it to be a virgin zone, it has to be refined, and we are going to learn how to refine it. because most fair value gaps you see price would have retraced in a way or another. Price would have retested. Here's another fair value gap, and as you can see, this candle, it has traded back into this zone and price dropped. So this zone is also no longer a virgin zone. So for us to get a virgin zone, we have learned the first rule, which is a clear structure. The second rule, which is a fair value gap that forms exactly beside the break of structure. You can see this as well, exactly beside the break of structure, not on top or below, exactly beside. You need to be able to identify rules before you trade. You need to be able to mark rules before you trade. You don't just trade whatever. You don't trade based on feelings. You trade based on logic, because the market, it generates feelings from humans, but the market does not operate based on feelings. It operates based on logic, because each of these candlesticks you see, they are perfectly engineered by the dominant market participants for a clear purpose. As we always say, either to manipulate, either to accumulate, either to manipulate, or either to distribute. So now we can see their accumulation in this correction, we can see their manipulation grabbing this liquidity, and here we can see their distribution. So based on the distribution of the fair value gap in this clear trend, we are going to use it as a trend following strategy. So now train your eyes, learn how to identify structures, and before you trade, you are going to put important factors into place, which are the timing, which are the day's timing, the session timing, as well as others. Do the needful to watch videos based on that, as we have lessons based on that. So now, how do we refine this fair value gap to have a virgin zone? To do this, we are going to mark out our box and mark 50% of this zone. To mark 50% of this zone, when you mark this box, it's already there. Put the line in the middle. I'm going to mark 50% of this zone. So that's how we have a sniper entry and a virgin zone. So we expect price to retrace to this zone and drop. We expect price to retrace to the 50%. As you can see, the 50% is not retested, and in fact this fair value gap, another beautiful thing is, if we go to a lower time frame, we are going to see a strong order block in the fair value gap, because it is not just a fair value gap here. On the higher time frame is a fair value gap, but when we go to the lower time frame, probably we are going to see some strong candlestick formations right there. Let us go to the 5 minutes. We are going to see a strong zone at that particular place. Don't think it should be that far. And if you are very good in refining other blocks, you should be able to get your zone. Right here we can see this is an engulfing pattern. You can also see another engulf. You can also see a railroad track right here. I'm sorry, you can also see a breaker block right here. So you can see that when you go to a lower time frame, the zone of the fair value gap, you always see a strong order block, and you can further refine it down there to get the best sniper entry. Although that will be a lesson that we are going to take later, or maybe on another day. It depends on how the spirit pushes me. So now let us take other examples, more examples of how to identify a healthy fair value gap. Probably let's go to the 1 hour and see if we are going to see any. Although always use the 4 hours to identify your fair value gap. Don't use the 1 hour, use the 4 hours. So let's go back to the 4 hour. Right here, let us attempt to see a clear structure. Let's zoom in. Right here we have a structure. We have a high here, we have a higher high here. As this structure is broken, we have a higher high here, we have a higher high here, we have a lower high here. In this zone here, we have a lower high here. Here in this zone, we have a lower high, and we can see this fair value gap here. Although you can see that price has retested this fair value gap, which doesn't make it a virgin zone. So what do? Once we see this fair value gap right here, then we expect another candle that is also a bullish candle to the upside to form. We expect 2, although we can take the trade if it is 1, but preferably it should be 1, 2, 3. So we can see the first rule is meant a clear trend, the second rule is meant a fair value gap beside the trend, and the third rule a minimum of 2 to 3 candles, which is 1, 2. Then we have all our rules met. So what do? The third rule is to refine it to get a virgin zone for the best possible sniper entry. So we mark the fair value gap and we mark 50% of the block. We mark 50%. Sorry. We mark 50% to get the virgin zone. And tada, price retest, and we expect price to jump further up. Let us go and take more examples. So said earlier, what do? The first thing we do is identify a clear trend. Mind you, this is a trend following strategy. Don't go and trade fair value gap in a choppy market. You only trade it in a trending market, because in a choppy market, probably most of the rules will not be met and you are probably going to be forcing the chart. But when you have a clear trend, you are able to spot it clearly in insights and trade away from it. The first rule, identify a clear trend. You have a lower low, a higher low, a lower low. Then we can see beside this break of structure, you can see the fair value gap directly beside this break of structure. It is another good rule. Then we have 1, 2, 3. So we have 3 candles forming. Then we mark out the virgin zone. So you can see how we followed all our rules. So after following our rules, we can see price did not retest the 50%. Price just came close before it dropped. You can see the trend is continuing. We have a clear trend, a lower low, a higher low, a lower low. Then beside this break of structure, we have a fair value gap. We have 1, 2, 3 candles. Then we mark 50%. Although this is not too healthy, because even in the 50%, price has retested already. So we have 1, 2. The first rule, a clear trend. The second rule, the fair value gap beside the trend, and we mark 50%. So just mark the 50%. Expect price to retest, and just as price retest, you can see what happens. Price drops. Let us take more examples. So you don't have to overcomplicate anything. Just to make sure that all your rules are met. Let us check out this. We have a fair value gap here. Even though price did not retest, let us look out for all our rules. We have a clear trend, a low, a lower low, a higher low, a lower low. We have the fair value gap. Beside this, you have 1, 2, 3. Good. Then you can see price has already infected it, so we refine it to get a virgin zone. We mark 50% and we expect price to retrace back. So preferably everything should happen within the week. So when you set this, don't be expecting price to hit the next week. It is best if it all occurs that week, but for the sake of examples, that's why we are marking it the way we are marking it. It is best it all occurs within the week. Just like this, you can see I have a clear example here. First, we have an established trend. You have a high, a higher high, a lower high. Now you can see the break of this structure. Beside this break of this structure, you can see the fair value gap here. It is already infected. So since it is infected, to have a sniper entry, then we mark it and mark out 50%. So when you mark the 50%, depending on how wide you want your stop loss to be, if the fair value gap is too wide, I'll also tell you what to do, how to scale down to a lower time frame. So once you mark it, you expect price came back, activated the order and jumped up. So we are going to try to learn how to refine further. Let us take more examples on your own. Also sit, learn and try to ruminate on the chart, try to expand your knowledge, and I can assure you that trading will be nothing but a cakewalk for you. Right here we can see an established trend. We have a high, a lower high, a higher high. Do the needful to watch our lessons on market structure, how to identify market structure, a break of market structure. So here we can see a break of market structure, a shift of character, and right here we can see the fair value gap. This fair value gap is already infected, then we refine it to 50%. Once we refine it, beautiful, then we take our entry and we expect price to ride further up. So you can see, so it is not complicated. You don't have to make anything difficult. Trading is very easy. You just have to be patient for your setup to play out, and once it plays out, you don't think, all you just do is execute, follow your rules and execute. So most importantly, I want you to view a clear structure. It is best you have a clear structure. So now we have a low, a higher low, lower low, higher low, lower low, higher low, and we have a lower low. So beside this lower low, beside this break of structure, you can see that the trend is continuing to a downside, and beside this break of structure we have the fair value gap here. So we refine it to 50% since it's already infected. I expect price to retest. Once price retests, then price is expected to drop. Price is expected to drop. So you set your stop loss just above here, the fair value gap, then you can see you set your risk to reward. So preferably I prefer a 1 to 10 risk to reward, as this gives me a lot of room. It gives me room for margin for error. It gives me room to make mistakes, because no trader is perfect. But since I have a very high risk to reward, I don't care if I make mistakes. The market will always make up for it for me. Right here we can see a fair value gap. Beside this break of structure, we already have an established trend. You can see a higher high. You can see a higher high, lower high, higher high, lower high. You can see just within this break we have fair value gap. We mark out 50%, price retest, and price moves up. So the most important thing you can do is to train your eyes how to see a clear market structure, a clear trend. And once you are able to identify a clear trend, you can incorporate this as a trend following strategy. Mind you, this is not a counter trend strategy like the liquidity, like the market mechanics. This is a trend following strategy. When you are trying to trade the fair value gap, you don't go against the trend, you go with the trend. Here you have an established trend, a low, higher low, a lower low, then this break of structure. We can see the fair value gap. Beside the break of structure, we can see another bearish candle, then we mark out 50% of this block to get a sniper entry. And you can see, boom, price retest and drop. So the reason is because those large institutions, immediately they pumped money and price began to rally down, they still have awaiting orders in this place awaiting to be filled. So just as price rallies down, then they create a correction, and we have buy orders here. We have some buyers in this zone. They create a correction, and these ones buy up, and once they buy up and markets retest this zone, then the pending orders become activated again and price drops impulsively, stopping out these buyers. So you can see the buyers in this zone. So the best thing in the market, once you understand liquidity zones, you will not panic. Even if the market hits your stop loss, you are going to have an idea of the reason why. You're not going to be angry at the market. You just know that it is the operator doing his thing. So let us widen the scope of our knowledge more. Let us take more examples. The more the examples we take, the better we are able to spot this. Here we have a clear trend. We have the beginning of trend, the lower low. You can see beside this break of structure, we have a bearish candle, a bearish candle. Beside this break of structure, although only advanced traders are going to be able to recognize this kind of structure, you don't have to panic if you are going to miss a trade or anything. The market will always give you endless opportunities. The market is not going anywhere. So you can see mark out 50% of this zone, price retest and drops. You can see just as the trend begins here, this structure is broken, this structure is broken, and this structure you just mark out 50%. Price retest and moves up. So it is not complicated. You don't have to make anything difficult for yourself by overthinking or whatever. Just once you see your setup play out, mark your zone and trade away from the zone you marked. So the first rule, do the needful to write down these rules. The first rules, we mark out a clear trend. The second rule, beside the break of structure, we make sure we see a fair value gap beside the break of structure, not above or below, beside. You can see beside the structure, then we mark 50% to get a sniper entry. Although we are still going to have a tutorial on how to mark sniper entries and what happens price drops. So it is that simple. Here we have a lower low, we have a low here, a lower low, higher low, a lower low. So you can see, and price drops. It is that simple. You don't have to overthink anything. Let us take more examples. So as said earlier, to recap all we have said, the fair value gap, it is a trend following strategy. It is caused by an imbalance in price as there's no trading done in between. So the market always has to create an equilibrium of buyers and sellers at all times. That is why market goes back to this zone, fills pending orders and moves in the intended direction. Here we can see a lower low, a higher low, a lower low. Then beside the structure, you can see the break of the structure. There's a fair value gap there. That's why they say the trend is always your friend. You don't go against your friend. Be faithful to the volatility of the market and it would reward you immensely. So you can see price retraces back to this 50% and drops. This is $1 million lesson. Even if you pay thousands of dollars for your mentors, they won't teach you this. But I have nothing to lose. Either I teach you or not, the market will always pay me. So you can see price barely spiked this zone. So always be patient with your 50%. You can see here we have an established trend, higher high, lower high, higher high. Beside this break of structure, you have a fair value gap, and after the fair value gap, there should be 2 or 3 candles in the intended direction. So let me say you are taking it on a buy pattern. Once you see this bullish candle, you want to see another bullish candle, 1, 2, 3, good. then this zone, since it is already infected, it is no longer a virgin zone, you mark it out to get a refined zone. And once you refine it, you set your stop loss right here. Preferably you set your stop loss here to get a tight stop. If you want a wide stop, you can put it below this candle, then boom. So it is that simple. There are many examples on the chart. Let's take more examples. Extra knowledge does the mind no harm. So right here we have an established trend, a lower low, you can see, and beside the structure here you can see a fair value gap. So let us mark it out. Mark 50%. We mark 50%. Expect price to come to the 50%. Price comes there, retest and drops. So it is that easy. You don't have to bother your mind. You can see the price drops. There are countless of examples on the chart. If we are going to take examples, we are going to do this forever. Mind you, this is not a healthy one. Let me teach you how to, so you know how you are going to mark a fair value gap that is not healthy. Here we can already see an established structure. You can see this fair value gap beside this established structure, this bearish candle. You can see the fair value gap right here. But you can see that the candle that closes next is a bullish candle, so you ignore this kind of pattern. It's not a healthy pattern. You ignore it. That's why in trading, knowing what to ignore is as important as knowing what to do. So you don't try to force the chart. The market will always give you another opportunity. Here we have a higher high, lower high, higher high. Here we can see the fair value gap. We mark 50%. You can see the fair value gap is beside the break of structure. This is 50%. This is the break of structure. And price comes to the 50%. Price barely retested it. Price did not even retest it. It almost retested it. You can see price went higher. So don't try to force anything. If price does not retest it, just be patient. So trade plan your trade your plan, and most importantly manage your risk and emotion. If you find this content useful, please rewatch, watch, learn on your own, because the great aim of this is for us all to take action. Learn on your own, mark your charts, learn to spot the clear market structure, learn to spot the fair value gap beside the break of structure and one or two candles in the intended direction. Then you mark 50% of the fair value gap, wait for a retest, put all factors to take a trade into consideration, then set yourself in a position to win.